In this video, let's explore what is classified balance sheet. Before we start, subscribe to our channel not to miss our new videos.
Before we start exploring what is classified balance sheet, let's reflect on the general balance sheet concept. Balance sheet is grounded by the accounting equation: assets equal equity plus liabilities. This means that everything a business owns must be financed either by the owners or by creditors. This equation ensures the balance sheet stays balanced. This is why it is called balance sheet.
Classified balance sheet is a special format of the balance sheet that organizes assets, liabilities, and equity into distinct categories. Balances of each category accounts are summed up and presented separately. It offers a structured view of a company's financial position. This structure helps investors and creditors better understand how the company's resources are financed.
In the classified balance sheet, assets are divided into current and long-term categories. Current assets include cash, accounts receivable, and inventory, all of which are expected to be converted into cash within 1 year. Long-term assets include property, plant, equipment, and intangible assets, which are expected to provide value for more than 1 year.
Liabilities are similarly classified into current and long-term. Current liabilities include obligations, like accounts payable, and short-term debts that are due within the next year. Long-term liabilities, such as bonds payable or long-term loans, are obligations that the company expects to settle beyond 1 year.
Equity represents the residual interest in the company's assets after deducting liabilities. It includes share capital and retained earnings. Share capital is the investment made by shareholders, while retained earnings are profits reinvested into the company rather than distributed as dividends.
Here you can see an example of the classified balance sheet. All items on the balance sheets are grouped into categories, and then totals of such categories are presented. For example, current assets, which include cash, accounts receivable, and inventories, total to $95,000. Long-term investments stand at $35,000. While property, plant, and equipment, net of depreciation, add up to $128,000, giving a total of $258,000 in assets. Current liabilities, including accounts payable, salaries payable, and other accrued expenses, total to $86,000. Long-term debt is $29,000. Total equity, combining share capital and retained earnings, amounts to $143,000. The balance between assets, liabilities, and equity highlights the financial structure of the company.
There are two common types of classified balance sheets: liquidity-based, which orders assets and liabilities by how easily they can be converted to cash; function-based, which groups items by their role in business operations, such as production assets or financing obligations.
Classified balance sheet is important, since it provides enhanced insight into a company's liquidity. By grouping similar items, this method adds clarity to financial statements, making them more understandable to investors. It also allows for better strategic planning by showing how the company manages its current and long-term financial obligations.
Despite its benefits, classified balance sheet can be complex and may overly focus on the company's current status, potentially underemphasizing future risks or opportunities. A detailed understanding of these issues is very important for accurate interpretation of the financial statements.
Thank you for watching. Subscribe to our channel not to miss new videos.
Let us know what kind of videos you like more: practical problems or theory explanation. Please leave your comment below the video.